Hi, my name is Jerry Jonas. I am the Real Estate Lending Manager for Aerospace Federal Credit Union. Today, we're going to be talking about the home equity line of credit. A home equity line of credit is similar to a credit card in the way in which you don't make any payments, you don't owe anything unless you take an advance on the home equity line of credit. The home equity line of credit can be used for a number of different types of programs in that, but it basically is used for remodeling. You can pay property taxes, income taxes. If you have an unexpected medical expense, and this is always good to have just as an added insurance that if something does come up, you will be able to do it. You can also use it to have any type of energy efficient programs like heating, air conditioning on your properties, solar panels, putting in new windows, any type of remodeling to your property. Some people may use them for purchasing automobile loans because the interest rate is so low. So you can use it for that. You can also use it for college education if you have some, either yourself or some children that are getting ready to go to college. It's always very, very expensive. So this allows you a little bit of a cushion in the event that you need it. Debt consolidation is a biggie. You'll find out that since we amortize this over a longer period of time than most credit cards in that, and the interest rate is substantially lower, that it can be advantageous to put all of your debts together and use this for a debt consolidation. Or, it could be used for a dream vacation. If you decide that you want to go to, Hawaii or anywhere, you can go on a cruise, you can use the money for that. So we have no limitations basically on what you can use the money for. New furniture, just upgrading your property. So virtually anything that you wish to use the funds for, we do not regulate that whatsoever. So basically, what is a home equity line of credit? It is a loan that is secured, typically in second position behind a first trust deed. It is a variable rate loan. We only make these loans on the individual's primary residence. So we can't make it on an investment property, a commercial property, anything else, since we use your home as collateral for this loan. Then you can borrow as needed up to the maximum line of credit that you've been approved for. The way that it works is it has a 10-year draw period. So you can take all the money out in year one. You can take part of it out in year one and pay it back, or not, just work it so it's amortized out over a 20-year period. The interesting thing is that during this draw period, once you take an advance or a draw, it starts a amortization of 20 years. The whole term on the loan is for 30 years, but you only have 10 years to draw and then 20 years to pay it back. The repayment on the loan comes at the last advance that you receive. So if you took all of it out in the very beginning on year one, didn't take any additional advances, and you paid it, let it amortize out, and it was paid off in 20 years, then the line would be closed at that period of time. But if you took an advance on day one and you had a low balance on it, and then you took another advance on year 9, you could go 9 years, 11 months. Then it would start that 20-year amortization, and it would run, throughout the remaining term. Just bear in mind that it does stop at the end of 10 years. You can no longer take advances but you have to pay it back within the 20 years from the last advance. Okay, so a home equity line of credit is, like I mentioned before, is secured by your primary residence. It can be a single family residence freestanding, it can be a PUD, it can be a condominium, it can be a townhouse. It can be just about any type of property that you own and live in. It is in second position unless, of course, you didn't have any other liens on your property, then it would be in first position. So it's it's a loan that is, I say, subject to all the terms of a second trust deed, or whoever was the first trustee is first in right, whoever has the second is second in right. Most lenders will allow a home equity line of credit if it's secured on your primary residence. No second homes or investment properties, as I had mentioned. Okay, we did talk about the draw and the repayment a little bit, but just to reiterate a little bit, a home equity line of credit is not a fixed rate for 5, 7, or 10 years, which is somewhat typical of second trust deeds. The home equity line of credit does have a minimum draw, however. The first advance, and this is to get the loan established and in the credit, is for $5,000. That can be paid back the next day if you wish, or if you're taking out home equity line of credit for other reasons, you'd maybe go above $5,000. The home equity line of credit has advances after that initial draw of as little as $500. So we don't allow anything less than 500, right? And the draw period does end, as we mentioned, at the end of the 10 years. But you have to kind of, weigh things out. I mean, you could, run it out, as long as you want, and then start, if you say, well, I want to re-amortize it out, go ahead and do it. You kind of look at it. Some HELOCs will have balloon payments. We're set up where we do not have a balloon payment on ours. We don't want any shock at the end of the repayment period. So we don't have balloon payments on ours. It is always based on the outstanding amount of the fully amortized. So, we will use it on a term of 10 years, fully amortized over 20 years. Some lenders and banks might serve it, they might work it a little bit differently. They may have terms for 25 years. Note that, that the 20 year is kind of the maximum that is allowed for credit unions by the National Credit Union Association. All right. It is, however, a variable rate. We have it set up in a way that it is tied to the prime rate, and it does fluctuate. A lot of different institutions will change their rate the moment that the prime rate or whatever indice they use changes. We only do it twice a year, April and October. And so we have a little bit of an advantage. If the rates are going up, you don't have to worry about that until those period of times. But we're not going to change it if it changes in April. We're not going to change it right away. We're going to wait until October to do that. And it does go, like I said, every 6 months. There are cap rates, which a cap rate is the maximum interest rate that can be charged on the home equity line of credit. And it also has a floor. with Aerospace Federal Credit Union, our floor is 2%. So if the prime rate drops, which we have not experienced that, gosh, in the last, I don't know when or if it ever got below 2%, but it will not go below 2% at any time. So you have to keep that in mind as well. So it does have a cap. We have a cap of 6%, and we'll talk about that in just a minute. Okay, the maximum loan amount that we have is based on, we have a matrix in that based on credit score and loan to value. And we will go as low as 20,000, but we also cap it at 200,000. And we also look at it as a particular loan to value. So when we're looking at it, we're saying, we take the first trust deed of, let's say, 400,000. We add this, the home equity line of credit, let's say 600 or 200,000, which gives us 600,000. If your property appraised for $1 million, you'd be at a 60% loan to value. We do not exceed 80% of a combined loan to value. That's putting the first and the second together. Right. We also look at our maximum loan debt to income ratio. And on a first trust deed, they bumped it to 50%. So we go a little bit higher on that. Being in second position does pose a little additional risk. So when you're looking at the risk factor, we say, okay, well, we only want to go 45% as a maximum allowed debt to income ratio, actually total debt to income ratio. We do, however, use your gross monthly income, verifiable income, I might add. So you may look at other companies that might say, well, we're going to use your net income after taxes and everything. No, we use the gross income in qualifying year. Credit score does enter into it. We want to make sure that you have an excellent paying history by maintaining your as agreed payments and making all your payments on time. So we want to make sure that you're doing doing your part, and as a reward, we will give you the maximum according to our matrix. If there is somebody that has a lower credit score, and we can discuss this on a case-by-case basis, we can probably still help you out a little bit, not as much as we would somebody with a higher credit score. Right? The APR is the actual interest rate that we charge. And it's, different than what they do on a first trust deed. So you have to kind of take that into consideration as you're looking at this. If we say today's rate is, say, 3%, that's what your APR is going to be. As mentioned before, we use, your primary residence as the collateral. We put a lien against the property, much like they do on a first trust deed, with a lot of the terms that are included in that. So we, want to make sure that as we're working on this, that you understand that you've got to be living in that property, right? Just like they have on a first trust deed, there is a right of rescission when you're refinancing. And you're looking at a 3-day period of time. So let's say Monday, you sign the loan documents and everything's fine. And you have to wait 3 days in between, which would be Tuesday, Wednesday, Thursday. As soon as we could fund the loan, or you would get your money in that, is Friday. So it takes almost a full week, as you can see, to do that. Now, a couple things to take, bear in mind, days that are not counted. Okay, Sundays is a day that almost every institution out there will not utilize as part of your rescission period. So, bear that in mind, and that will, keep you out of trouble thinking you're going to get the money sooner than you are. Appraisal is needed on all properties, much like a first trust deed. And, that is so that we can determine what the combined loan to value is. We typically at this time are not using what they call an automated valuation model or a drive-by or a desktop. We're using a regular appraisal to get it done. We're not offering any type of a teaser rate. Teaser rates are rates that are used to induce somebody to apply with an institution. If, for example, if our rate was 3% today, and I went out and offered you 1.5%, that would be a teaser rate because it's not being utilized to calculate what the true interest rate is. Typically when there is a teaser rate, there is interest that is due on that particular loan because it accumulates. You're not going to get that rate for nothing. So try to avoid lenders that are using a teaser rate. Now a couple examples, and we kind of touched on this a little bit, but let's just look at this. Example number one shows somebody that is going in and they want an 80%, or they want the max they can get out of their property. So what we would do is we get the appraised value, and if the property appraised for $500,000, 80% of that is $400,000. In this particular case, they have a first trust deed of $280,000. So we would subtract that from the $400,000, and it would show what we would be able to allow the borrower, or you, the member, to have for a loan amount. In this particular case, it would be $120,000. So, if they requested, the loan request was for $200,000, we would not give you that additional $80,000. Okay, if you follow this this process, you'll be on top of where or how we come up with our loan amount. Next scenario is a property appraised for $300,000. 80% of that is $240,000. If they have a first trust deed of $280,000, meaning they have a higher loan to value than the 80%, and that could be a loan that was a purchase that people put a small down payment, and that they would not be entitled to anything. Right. So if they applied for $200,000, we would not give them the $200,000. Next scenario, property is worth and appraised for $700,000. We take 80% of that, which is $560,000. They have a first trust deed of $280,000. We now would be able to grant them the loan of $200,000. Okay. So that's how you would arrive at the amount that you would qualify for. Okay, here's a basic description of the program, not meant to be looked at in a way in which it would take or be held to complete disclosure, because it doesn't have complete disclosure in here, right? But it has a lot of the basic facts that you will want to look at. Once again, it's called home equity line of credit. It is they call it a 10/20, as we talked about before. You can draw on the loan for 10 years and you have a 20-year repayment term. The minimum loan amount is 200,000, and the maximum is 20,000, and the maximum is 200,000. Maximum combined loan to value is 80%. And the way that we arrive at the interest rate that we will be charging you is we take the prime interest rate and we subtract 25 basis points, or 1/4%. So the prime rate let's say the prime rate's 3.5%. We took 1/4% off of that, reducing it to 3.25%. So we would not charge you the full prime rate. A lot of institutions out there are charging the prime rate or some other index that they use plus a certain dollar amount. We don't do that. We go below prime rate on it to try to make it a little more advantageous to you. The cap on this particular loan, or on the home equity line of credit, is 6% over the initial rate. So you take that 3.25% and you add 6% to that, would leave you a maximum rate of 9.25%, should it ever get to that point where the prime rate goes up substantially. So even at that, you look at what you're paying on credit cards, and it's pretty hard to beat. As we mentioned before, the minimum, the floor on this particular program is 2%. Repayment period, as we discussed, is 10 years from your last advance. And that repayment period is 20 years from the last advance. So you could tailor the loan any way that you wish, as far as how much money you're going to owe. In that, you might say, I want to have it re-amortized. I want to keep my payment a little bit lower. So you wait till you get closer to the end of your term, right? Maximum initial draw we talked about, $5,000, and then we look at what the minimum draw period or minimum draw amount is, and that's $500. And you can do this very simply by just logging on to our website and transferring. There's a transfer button. You can transfer the $500 or whatever you want into your share account or any account that you have, with us. Most people will put it into their checking account so they can utilize the funds in that. Right? Okay, the rate and the and we talked about when the rate and the payment change. Now, all of our payments have a payment due date of the 27th of each month. But in this case, remember we talked about, when it can change. It only changes twice a year, doesn't change as the prime rate changes, which can be to your advantage. So keep that in mind. So we're looking at that as the change dates. The rates based on prime, as we talked about, the prime rate that is in effect 30 days prior to those change dates. The reason for that is we have to give you notification that it's changing. So the prime rate, look at what the basis is on that for March 1st is the rate we're going to use for April 1st when we, if we make a rate change. And the same for the, the October change date is going to be information that is provided for September 1st as to what the prime rate will be. Okay. Remember, the rates cannot increase more than 6% over your initial rate. The maximum rate that you can have by law, not according to our our program as it's set up, the structure today is 18%. You would not be charged 18% if you took your loan out today. The maximum you would be charged would be 9.25% over the 3.25% initial rate that we have, right? And then once again, it'll never go below 2%. It'd be nice if we got in that position where it was at 2% though. So anyway, rate remains in effect for 6 months, and the monthly payment is calculated from that effective date during that period. And then, I just mentioned at the bottom that it is a competitive feature that we have, and it is very helpful in the interest rate environment that is going up. Underwriting requiremits. This is something that you need to keep in mind as you're getting ready. And I always tell people, if there's something in here that you might be asked for, go ahead, start putting it together, and that will expedite the loan process for you. So what's required? We get 2 years W-2s, pay stubs. The pay stubs are the most recent 30 days, and the 2 years W-2s or tax returns if applicable. We do run credit, so we know what your credit score is and your paying habits. If there's anything that requires an explanation, and this happens from time to time, something might show up and go, wait, that's not mine. That happens. Or you have something that was paid off and maybe 30 days ago, and it's not showing as paid off on your credit report. It does take time for the lenders to process all the information necessary to remove it from the credit report. Okay. And as we say, it requires a full appraisal. In this time, we're not using a drive-by or an AVM. Now we do manage cost a little bit here. We manage the cost for the HELOC because we don't go and get a full-blown title report. So we'll keep the cost down there. We try to keep the cost down on the credit, for the credit union, since we're running the second, we're going to be in second position. So we're going to move ahead with the lien. We keep the, try to hold those costs to a minimum. We won't typically, if a loan is in first position, the mortgage is, the mortgage pay option or an interest only, or has a balloon payment. We just don't do that. We don't approve loans, HELOCs that way at all. It can fall into first position in the event, but not as on a pay option, but in the event that you don't have a first trustee. We have a couple of those. That doesn't happen very often. Most of the time somebody has a first trustee and they just go ahead and take the HELOC out. Now, here's the way that the fees, since that is a big part of this, are set up at this time. Appraisal fee for home equity lines of credit in the states mentioned is $450. Actually, in all states right now charging $450, unless it's something unique about the property. It's sitting on a large parcel of land. It's not in a tract of homes. Something unique that makes it difficult for the appraiser to come up with some comparable sales. The recording fees, we keep that low, $50. Credit reports only $25. Title insurance is, in the states mentioned, there's $125. The other states, it's still $500. We have to do a flood certification, make sure you're not in a flood zone. If you are, then we would ask for flood insurance. So the cost can be as low as $775. Excuse me a second. Our processing fee, which we add to that, is $299, which is minimal. So it's $1,000, $1,100, up to maybe about $1,400 would be, or in most cases, be your fees. A lot of costs are estimates because we don't have control over those costs. So if you equate that out, the more you borrow, if you're looking at what's the cost compared to how much I'm borrowing, if you only borrow $20,000, the cost of that $1,100 to $1,400 is higher. But if you go all the way down to like the $200,000, you take the maximum out. And I usually tell people, go in, take the maximum that you can qualify for. Take that $200,000, because you never know what's going to happen. You may say, well, I only need $20,000. Well, today you may only need that, but something could come up. Your air conditioner, your heating unit, your roof starts to leak. You decide you want to do some remodeling to the property. So if you take it, there's no harm in taking it. You might as well have it as a cushion or some type of a reserve, right? Okay. The prime rate has changed and does continue to change as we go through the year. So if you're looking at what the historic prime rate, you can see it's pretty consistent. Doesn't have a lot of fluctuations. We've gone through some drastic market changes in the last couple of years, which drove the rate down right now the prime rate's sitting at 3.25%. So as we talked about all the way through the presentation, we give you 0.25% off of that. It's a reduction. So what you're actually paying is 3% today for a home equity line of credit. One thing to take into consideration is it is tied to the prime rate and it does fluctuate, so it could go up. But as mentioned before, with a 6% cap interest rate, meaning nobody's going to touch the loan if it goes up to that maximum amount. And that maximum amount, if it's at 3%, would be 9%. So nobody can touch it once it hits that max, if it ever does. And then looking at the scenarios that we have up here, it would not have gone above that 18% that we were talking about that we are allowed to charge. The highest in this scenario that it would have run is in 2018 and 19. It could have run up to 11%. Still well below what you pay on a lot of personal loans and credit cards. We currently are offering, and you can see on the date that we have here, we're currently offering waiving that processing fee. So when we were talking about the $1,100 and the $1,400, if you apply now, and applications received between May 1st and June 30th, you have till June 30th of this year to get your application in and get it funded before July 31st, you will save that $299, which would then reduce your cost to say $800 or $1,100, depending on which state your property is located in. So that is a real incentive for you, and we want to offer that to everybody that listens to this presentation. The ones that are not listening are not, they got the loan application in, will typically be paying a higher rate on that. Okay, so Just remember, applications have to be in before June 30th, and the loan has to fund by July 31st, 2021. All right. If you have any questions whatsoever, my phone number, that's my direct line, and that is my email address. You can contact me at any time, and I will be more than happy to go over any questions you have. We can even talk about, well, see, I don't know if I'm going to qualify or not qualify. I will be able to help you out with that as well. Thank you very much for joining this presentation, and hopefully it's been helpful. Have yourself a good day. Bye.